Something huge has just happened, and if you care about property in Australia, you need to hear this. In the space of a few weeks, the entire economic conversation has flipped. Inflation has spiked. Rate cut hopes have now collapsed. Two of the biggest banks said, that's it, no more cuts. Some economists even think the next RBA move could be up. And after all of that chaos, after all of those headlines, people started saying, well, maybe the market will finally slow down now. But then Domain released its 2026 forecast. This is property forecast by Domain for 2026. AMP also revised their forecast. CBA came out with an updated forecast, and every single forecast kept reinforcing the same uncomfortable truth. The market is not slowing down. If anything, the outlook is getting hotter. And now the final piece has dropped. SQM Research have just dropped their latest data. The group every serious analyst watches is SQM, and their 2026 forecast is now out. It is louder, sharper, more precise, more detailed, and in some cities, way more aggressive. And here's the question, why should you even care? Because SQM's forecasts are the closest thing Australia has to a live pulse check on the housing market. And if they are right, 2026 might not be what you think. So stay with me, I'm going to explain exactly what SQM sees, what scenarios they're modeling, what numbers they're projecting, and what this means for your buying or investing plans. This is the forecast you absolutely cannot ignore. Pay very close attention here. This is where most people get left behind. SQM isn't like Domain or realestate.com.au who run marketplaces. SQM is a pure data company. They track real-time rental vacancies, real-time listings, real-time asking prices, real-time rental yields, real-time buyer activity, all the stuff that tells you what the market is actually doing, not what someone feels it's doing. They also have multiple scenarios. If the economy weakens, they model that. If inflation stays sticky, they model that. If the RBA doesn't cut rates, they model that too. It's detailed, it's realistic, and honestly, I trust their forecast more than most others because they're not guessing, they're measuring. And for their 2026 outlook, it's clearer than ever. Every single capital city rises, every single scenario, no exceptions. This is the part that will actually shock a lot of people. SQM's base case is a slow economy, steady rates, normal migration year. Nothing crazy, nothing booming, just a steady, boring Australian economy. And even in that boring economy, the property market does not slow down. Here's what they're expecting in 2026. Perth, plus 12% to plus 16%. Those are big numbers. Brisbane, plus 10 to plus 15%. Adelaide, plus 10 to plus 14%. Darwin, plus 12 to plus 16%. Those four cities are running away again. And honestly, I'm not surprised. Supply is low, migration is high, borrowing capacity is rising, and competition is brutal. Then you've got Melbourne, plus 4% to plus 7%, Hobart, 4 to 7%, Sydney, 3 to 6%, Canberra, 3 to 6%. These are the slower markets, but even their slow years look like good years. And remember, SQM is not predicting this under perfect conditions. They are saying under a boring, ordinary year, slow economic growth, nothing crazy, steady unemployment, no rate cuts until mid-2026, this is their prediction. Hang on, because this part changes everything. SQM has 4 scenarios for 2026. Scenario 1 is the base case, we just covered that. 6 to 10% national growth. Scenario 2, sticky inflation. This means no rate cuts. Growth will still happen, about 4 to 8% nationally according to SQM, and double-digit growth still hits Perth, Brisbane, and Adelaide. This is a scenario everyone thinks will crash the market, but SQM says no crash, not even close. Scenario 3, global slowdown spillover into Australia, our economy will weaken, unemployment will rise, and guess what? Still growth, 6 to 8% nationally. Perth, Brisbane, Adelaide, still double-digit growth. Now lastly, scenario 4, we have an economic rebound if things go well. This will mean lower inflation, more rate cuts, stronger sentiment. The numbers get crazy. Under this scenario, SQM says we could expect Perth to grow 17 to 21%, Brisbane 13 to 18%, Darwin 14 to 18, Adelaide 14 to 18%, Sydney and Melbourne 7 to 11%. This is the don't blink or you'll miss it scenario. But here's the key message of the whole report. No matter what the RBA does, prices rise. No matter what the economy does, prices rise. Every scenario points up. There's no scenario here where the market crashes or even goes a little bit backwards. And if every scenario points up, even the slow ones, even the high inflation ones, even the global recession ones, when the real question becomes this, what does this actually mean for you? Whether you're a renter, a first-home buyer, a homeowner, or a property investor, how does a market like this affect your next move? If you're a home buyer, this means the affordable end of the market is about to get even more competitive. If you're a renter, SQM says rental pressure will stay high unless migration slows dramatically, and even then the improvement will be tiny. If you're a homeowner, your equity is likely to rise again next year, improving and growing your wealth. If you're an investor, let me be clear, this kind of environment doesn't scare investors off, it pulls them in because they know a few things. Firstly, the 5% deposit scheme is bringing thousands of new buyers into the market. Secondly, wages are rising. Thirdly, migration remains high. Also, the RBA already lit the fire with 3 cuts this year. In addition, the big banks, KPMG, Domain, ANZ, Westpac, AMP, all expect prices to rise again next year. Investors remember what happened last time rates were rising. Prices fell for a short period, but in the second half of the tightening cycle, prices rebounded fast. So in an environment of rising interest rates, we still had house price growth. It taught investors something important. Rates matter, but not as much as population, demand, and supply. And right now, demand is strong, supply is weak, and the competition is brutal. That's why investor lending jumped nearly 40 billion last quarter, and it is not slowing down. So here's my take. SQM has just confirmed what I've been saying for almost a year now. The market is not done, not even close. I've been talking about the forces behind this: migration, low stock, rising wages, government incentives, borrowing capacity improving since early 2025. And now every bank, every economist, every major research house, they're all catching up to the Freedom Property Investors forecast. But here's the biggest difference. Even with inflation running hot, even with rate cuts on pause, even with uncertainty everywhere, SQM still sees strong price growth in 2026. So if you're waiting for things to cool down, you might be waiting a long time because the truth is simple. The property cycle still has fuel, the shortage is massive, the demand is real, and 2026 will not be a quiet year. I'll say it again, if you have anything to do with property, whether you're buying, investing, upgrading, downsizing, please pay attention to this. The next year could be big. This is your daily property update, your 5 to 7 minute breakdown so you can become a real property insider and make the right moves in the property market. If you got value from this, please subscribe so you never miss a video, and let me know your comments. I generally read every single comment. If you want to continue learning about the property market, I also put together this really great video related to the subject. Go ahead and watch this video now.